Firm HL and LL are identical except for their financial leverage ratios and interest rates they pay on debt. Each has 20 million in invested capital, has $4 million of EBIT, and is in the 40% federal plus state tax bracket. Firm HL, however, has a debt to capital ratio of 50% and pays 12% interest on its debt, where LL has a 30% debt to capital ratio and pays only 10% interest on its debt. Neither firm uses preferred stock in its capital structure. Calculate the return on invested capital for each firm. Calculate the return on equity for each firm. Observing that HL has a higher return on equity, LL Strayer is thinking of raising the debt to capital ratio from 30% to 60%, even though that would increase LL's interest rate on all debt to 15%. Calculate the new return on equity for LL. So the given data is invested capital. That is same for both firms, that is $20 million. EBIT is also same for both firms, and that is $4 million. EBIT 4 million, and the tax rate is 40%. And for HL firm, debt to capital ratio 50%, interest rate is 12%, and for the LL firm, debt to capital ratio is 30%, and the interest rate is 10%. And we have to find return on invested capital. The second requirement is return on equity, and the third requirement is to find revised return on equity. Firstly, we will find return on invested capital. Return on invested capital is equal to EBIT into 1 minus tax divided by invested capital. So EBIT is 4 million into 1 minus tax rate is 40% divided by 20 million, that is 12%. As the invested capital, EBIT and tax rate is same for both companies, so return on invested capital for both firms will be 12%. Now we will find return on equity. Return on equity is a ratio used to analyze the performance of a company. Its formula is net income divided by total equity. If you have any questions related to finance and financial modeling, you can contact us. We will try our best to provide you best solutions. Thank you. Take care. Allah Hafiz. Firstly, we will find the total equity, and to calculate total equity, we will firstly find the total debt, and we will find debt by using this ratio. Due to space issues, first we are going to calculate return on equity for HL company. To find the return on equity, we will firstly find total debt, and debt will be computed by using this ratio, debt to capital ratio. Total debt divided by total capital. Total debt divided by total capital. In this question, the debt to capital ratio is given as 50%, 0.5 divided by total debt divided by the invested capital is given, that is 20 million. So total debt will be $10 million. After finding the total debt, we will calculate total equity. Total equity is equal to total assets minus total debt. That is 20 million are total assets and the debt is 10 million. So equity will be of 10 million. Now we can find the net income by using the total debt. Now we can find the net income. EBIT was 4 million. Interest 12% of 10 million, that is 1.2 million will be interest expense, and EBT will be EBIT minus interest will be EBT, and that will be equal to 2.8 million, and the tax rate will be 40% of EBT will be the tax amount, and that will be 1.12 million, and the net income will be 1.68 million. So finally the return on equity is net income, that is 1.68 million divided by total equity, that is 10 million. So return on equity will be 16.8%. By performing the same procedure, we will find the return on equity for the LL company. Firstly, by using the debt to capital ratio, we will find the total debt, and debt to capital is equal to total debt divided by total capital. That will be debt to capital 30%, 0.3, total debt that we have to find divided by total capital 20 million. So total debt will be 6 million. By using this, we can find the total equity is equal to total capital minus total debt. The total capital is 20 million minus 6 million, and the total equity will be 14 million. After that, we will find net income. EBIT is 4 million. Interest, that is 10% of debt, that was 6 million in this example, that will be 6 lakh. So EBT will be 3.4 million. Tax rate will be 40% and the amount will be 1.36 million, and the net income will be 2.04 million. By using this, we will find return on equity, that is net income, that is 2.04 million divided by total equity, that was 14 million. Return on equity is 14.57%. After that, we have to find the revised return on equity. And for the revised return on equity, debt to capital is 60% and the interest rate is 15%. Again, we will find firstly the total debt by using the debt to capital ratio. Total debt divided by total capital, that is 0.6. Total debt that we have to find divided by total capital is 20 million. So total debt will be 12 million. And by using this, we can find the total equity, that is equal to total capital minus total debt. Total capital is 20 million minus the total debt is 12 million and the equity is $8 million. After this, we will find net income. Firstly, EBIT 4 million, interest, that is 15%, and that is 1.8 million, and the EBT will be 2.2 million. Tax rate is 40%, and that is 8,80,000, and the net income is 1.32 million, and the return on equity is 1.32 million divided by 8 million, that is 16.5%. So the new return on equity will be 16.5%.